Well, hello, welcome there. It's Mayor Solomon, M. Solomon. We are back with another podcast, presentation, servicing. We're going to use an actual file. We're going to show you what's happening with the SPS servicing statements, and we might as well get right into it. We have here a copy of this is actually the example statement that SPS puts online. You can find it yourself. As you can see, it's not very legible, but we still can give you some kind of an idea of where we're going to go with this discussion today. We believe that there's some things inherently wrong with the SPS statements, and we believe that their staff and the executive management have a duty to disclose to you under RESPA and TILA the significant aspects of the disclosure requirements based upon, well, going back to Dodd-Frank and other legislation that fall under Regulation X of RESPA. But what we're going to focus on today is the statement, SPS statement, and we're going to focus on this area right here. Let me see if we can get the trusty laser right there. We're going to focus on this area right here, especially where it says opening, it's called account information. In the first line item you see there is interest-bearing principal or interest principal. Interest-bearing principal right there, and you'll see a loan amount or a number. And then skip one line, you'll see outstanding principal, and you'll see a matching number. These two numbers match, okay? We call those contra accounts or contra accounting. But then you should see a rate, and the rate should be right about there. And then we're going to ask you to jump over here and take a look at the amount due. And in the amount due, they're going to show the payment calculation. In fact, they have these options now. These are loans that are current. And in these options, you'll see option 1, 2, 3, and 4. And in option 1, it's going to give you your principal and interest. And I think it includes taxes and insurance, but we're only interested in principal and interest right now. Option 2 is an interest-only option, and you can see there's nothing there by design, and with the file that we're looking at, there's nothing there. And then you have the fully amortized. So you have a minimum payment and a fully amortized payment. Those should match each other. And then you have an acceleration option. We're not going to get into that today. So that's the SPS statement. Again, what we're looking at is the two balances here and how they arrived at that. The interest rate that's being charged, and it should say on the bottom interest rate. And then we're going to look at how they assemble the different categories of payment. Okay, so let's go to our next screen. Great. Here we go. We call it the SPS insider law algorithm. And when you have a certain style or method of doing something and it fails to meet the disclosure requirements, it can only be for no good, or it would fall under errors and omissions. But here, as we said, going back to the previous page we just showed you, you have an outstanding principal. Outstanding principal. Here, the outstanding principal for an actual case in California is $370,535.45. That would be your principal according to SPS. Then we went to the bottom of that section of account information and picked up the interest rate. And guess what? When you multiply the outstanding balance by the interest rate, it gives you the annual debt service, or the amount that the borrower pays in payment, minimum payment. Or no, excuse me, interest only. That's an interest rate that only pertains to interest. So that's the amount of interest the borrower is going to pay in the year. Take the loan times the rate. That gives you the annual debt service. Okay, we jumped then to the box below, and it had a minimum payment. The minimum payment here is 2041. Well, if you multiply that times 12 per annum months, that gave us an annual payment of $24,502.56. Now, if your annual payment's $24,502.56 and the interest portion is $13,880.26, I wonder what happens if we subtract the two. Well, if you subtract from here to here, you're going to get the amortization, or the principal portion of the mortgage. So we have, I guess they're asking us to take their word for it or calculate this by yourself. I don't think the average person can do that. So what we have here is the annual interest, the annual payment based on the interest, the annual payment based on what they're showing, minimum payment. And then if you subtract those two, that's how we got the principal, the difference, which should be the amortization. What's interesting is if you want to verify the interest amount, divide it by the rate, and there, sure enough, it gives you the principal balance outstanding, 370,535.45. Then if that's the interest portion, right there, interest-bearing principal. Okay. Now, if you take the other difference, the margin, and you divide it by the 370,535, right, you get a negative 2.867, which would be your amortization rate. So when you add when you subtract a negative and a positive, you should get subtract, you're going to get 24,502.56, I can think. And then the same thing, if you subtract these two here, you're going to get a positive 6.613. But when you subtract these two, okay, we subtract these two, you're going to see that subtracting these two gave us 24,000, subtracting these two gave us 6.63, but subtracting these two, positive and positive, gives you 0. So these two balances are contra accounts that offset each other to 0. Yet when you take the combined payment and capitalize it, meaning divide it by the combined rate, it reconstitutes 370,535.45, and that would be subject to a taxpayer 1099-C. So I think this session should be especially intriguing and interesting to you, because I think we found where the controversy over the 1099 arises, and it arises in the reconstitution and recapitalizing of the actual payment by the combined rate, meaning there is nothing to foreclose on except for a 1099-C. That's interesting. Let's continue. So now we're asking SPS what is right and what is wrong with this statement that the borrower received in September of last year. SPS, something is not right and you can't explain why. Let me show you. Number one, why is the minimum payment posted missing a rate? Why is the minimum payment that you post missing a rate? Generally, doesn't a servicer post the rate and then show the payment instead of showing what the minimum payment posted is and not putting a rate there? It's a little bit strange, cart before the horse. Number two, each of the balances bifurcate into separate accounts. That's by your own admission. So what I mean is you have a separate principal and a separate interest account, and you're showing two balances. And the last time I looked at basic math and contra accounting, it said one offsets the other at a certain point in time, and that means you're foreclosing on 0. That might be why you're laying low and serving two masters here. Number three, two masters being the secondary and the servicer. Third, the interest only rate posted, that is correct. I assume it's correct, but you say there's no interest only payment option available. So you have an interest rate, and we calculated the interest only rate but as posted, but it's not available. Strange mixture of science and religion here. So go to number 4. Both balances, as I said in number 2, both balances bifurcate, and I believe they're being capitalized. That means that you guys are taking advantage of a APY, not an APR. APY being annual percentage yield, and that would have to do with installment sale accounting, installment sale reporting, the installment sale method of accounting, and you make no mention of that anywhere in your statement. That's not a real mortgage. So if both balances are capitalized, that means that you obtained the interest-only account, or the outstanding principal balance, and the interest-bearing principal accounts. Those two balances, which you show on the left-hand side of your statement, those were actually capitalized from one thin deposit, and that means that you could borrow money from a depositor and then capitalize your own mortgage without ever putting 1 cent into the deal. And I think that's what they were saying when the regulators first uncovered the cause and purpose of the crash. The cause of the market's crash said that the banks had no skin in the game. Last, I threw in here the combined payment is capitalized. Okay, the combined payment is capitalized with a typo, OT. The combined payment is capitalized subject to a 1099-C, and that's going to your borrower, but the borrower only gets that if they're in default, so why are you even servicing this loan? But anyway, balance A, balance B, they offset each other. That leaves a balance C, which would be the combined rate for the interest account and the principal account. That combined rate, I think, was 6 and change. That came out to the outstanding principal balance, and that is a taxable event. Let's continue.
So we continue. I have viewers, and by the way, if you get the chance, la-di-da-di-da, hit the subscribe button, and we'll keep you posted with all the latest changes and things that are happening in courts around the country, and things that have happened in our cases where we testify. So please hit the subscribe button, and also anything that you have as a question pertaining to your deal. Even if you're a banker saying, hey, I don't buy any of this, post it, will you, in the comments section so people can benefit from that. Let's hear what's going on in your case. And of course, I'll give you my email that you can email me your statement if you'd like us to review it, no cost. But move on to the Bureau of Consumer Financial Protection, BCFP. And we're looking at the final rule, the official interpretations. These are the rules passed under Dodd-Frank. In summary, the final rule implements provisions of the Dodd-Frank Wall Street Reform and Consumer Protection Act regarding mortgage loan servicing. And we're looking here specifically the final rule. It implements Dodd-Frank, the Act, and sections addressing servicers' obligations to correct errors asserted by mortgage loan borrowers. Do you think we came up with a few here today? We need answers, and the motivation for doing this presentation was that SPS is not being very attentive, and they are skirting the issue, and they're coming back with, you made a contract, you signed for the loan, so don't ask these questions. That's not right. So again, we're referring to the attorneys to Dodd-Frank and the certain sections for the servicer's obligation to correct errors asserted by a mortgage loan borrower, and at the very least give some decent explanations, which we're not getting. And then also the second benchmark of that, the interpretation of the final rule, was to provide certain information requested by such borrowers, and that's what we're doing. The purpose of this presentation was to show you back in the previous screen the things that we need answers to and the things that we're not getting a response on.
So let's wrap this up. Once again, we're looking at the Bureau of Consumer Financial Protection. Whatever your opinion is of that agency, it's more important that you understand what legislation was passed and what amendments were made to our RESPA, especially, I believe, Regulation X. In addition to what we've shared with you, the final rules address the servicer's obligation to establish reasonable policies and procedures to achieve certain delineated objectives. I want to ask an attorney what a delineated objective is, but nonetheless, it's also to provide information about the mortgage loss mitigation options to delinquent borrowers that are available to you, still available to you, or were available to you and you did not know it. We also refer to these practices, procedures, and policies for providing delinquent borrowers with a continuity of contract with servicer personnel capable of performing certain functions. What does that mean? That means upon servicing transfer, you're entitled to honest, straightforward answers by people that don't have to put you on hold, make you wait, and then say, we'll get back to you. The purpose of the new legislation was also to evaluate a borrower's application for available loss mitigation options, determining whether you were or were not eligible. And if they said you were not, we'd like to take a look at the analysis that they used. They have to provide analysis on how they qualified you. And last or further, this final rule revises provisions relating to mortgage servicers' obligations to provide the disclosures, all disclosures to borrowers in connection with the transfer of mortgage servicing, and a mortgage servicer's obligation to manage escrow accounts, usually which refers to as cash accounts with for servicing interest and taxes. So that just about wraps it up. So that wraps up another session of Your Servicer and Mortgage Statement. We would love to talk to you. If you want to get a hold of me, you can reach me at area code 202-550-8364. That's 202-550-8364. We have offices in D.C. and Los Angeles, as well as Nevada. You can also reach me at Secondary Trade Desk. I want to see your statement. If you've got one, no charge. Secondary Trade Desk, like secondary trade desk at gmail.com, secondarytradedesk@gmail.com. Doesn't matter if you have SPS or any one of the other variety of servicing agents. We just want a chance to look at your statement and share with you what we find and what we believe is important that you may not be paying attention to, or that you and your attorney may miss if you're in litigation. Once again, thank you for joining us, and God bless.